Well, joining us to begin the week is Kyle Rodder from Capital.com. Kyle, great to catch up with you again. Let's begin with the news just over the weekend, obviously with a trade deal done between the EU and the US.
Yeah, obviously whispers of it last week, but it's basically taken that risk off the table now. The 15% average tariff rate seems, basically in line with where the markets were hoping. Obviously a lot higher than where we were before the second Trump administration, but a lot better than the sort of 30% and then, at different stages 50% threatened on the EU. So I suspect that this will kind of take that risk, more or less off the table and mean that market sentiment is pretty well supported to kick off the week. I mean, to throw on that as well, we've got these rumors now that the US and China will agree to another sort of extended pause for about 90 days when both sides meet in Sweden this week as well. So, this August 1 deadline, final deadline, as it was kind of touted to be for a little while, has kind of turned into a bit of a nothing burger, and trade quite fortunately has been sort of taken off the table, it would seem, for now as a critical risk. I mean, there's still a lot of trade deals to be done. There's speculation to what extent they will materialize over the next few days as well. There was been talk of rates between sort of 15 and perhaps 20% or even more, 50% I should say, on certain trading partners. But for the most part, Japan, the deal there's been done. A deal with the EU seems to have basically been sort of locked in, and now with a deal between the US and China sort of being kicked down the road, I think markets will sort of buy into that news.
Well, that comes ahead of a big week on the data calendar. Certainly in the States, we do have that Fed decision. Of course, no move expected, despite the pressure that Donald Trump continues to exert on Jerome Powell. Also got key jobs data as well out of the States.
Yeah, I mean, I don't think it's too far-fetched to say that this is perhaps, the biggest week as far as calendar risk for the year. I mean, again, the August 1 trade deadline has kind of diminished a little bit as far as its importance. But I mean, if you sort of stack it all up, obviously, as you just mentioned, all the data flow, it's incredibly significant. More or less, the Fed's not expected to cut interest rates. They're still looking for data to sort of get a sense on what's happening with tariffs and its impact on inflation. But we get that as well. We'll get the PCE read. It's expected to show a sort of a modest pickup in core and headline inflation, as potentially it shows the pass-through from higher tariffs to consumers, which was fleshed out in the CPI release. And then perhaps more critically as well is just this non-farm payrolls release, which is probably going to show a fairly resilient labour market. And I think this is the argument at the moment, is that we've got ample reason to think that there are price pressures coming down the line. But then not only that the US economy has held up remarkably resiliently. It's the PMI surveys fleshed that out last week. We had some jobless claims figures last week, which was a little bit better than expected as well. If you're looking at the labour market for any evidence that the Fed needs to sort of cut interest rates and support the economy with looser policy, it's very likely that you're not going to see that in the non-farm payrolls report. We're just not seeing that in the data in general. So as a result, I mean, this could kind of end up being a little bit of a firestorm as far as the Fed leaving policy unchanged, the data coming in maybe fairly solid, the president becoming fairly agitated by that because there won't be much of an impetus to cut interest rates. But I suspect overall it'll actually be a good news situation. If we get a solid labour market, it will continue to show that the US economy has proven to be remarkably resilient, but despite higher tariffs and trade uncertainty. And I think that will be something that can actually be a tailwind to the markets. That the economy is remaining robust rather than a headwind that, it means that the Fed can't necessarily cut interest rates.
Interesting. I mean, it also comes, obviously, we're in the midst of earnings season out of the States. And look, to this point, a lot of those consumer-facing companies appear to be absorbing those higher tariff rates. Maybe reach a point, though, perhaps, where they have to start passing them on to consumers.
That's the question. I mean, there's, that huge buildup in inventories that we got going into the tariffs. Clearly, businesses are always reluctant to raise prices if they don't have to, because you really never know what the impact will be. And there isn't, again, that sort of significant pass through to consumers yet. We haven't necessarily seen an impact on margins just yet either. But again, we're not dealing within a business environment that's really wearing fully the higher costs associated with tariffs. But more broadly, from a general high level point on earnings so far, we did get significant earnings downgrades coming into this earnings period, mostly because of the expected impact of tariffs on corporate profits. But overall, companies have exceeded expectations. About 83% of companies that have reported so far have beaten street forecasts. That's the best number in about 4 years. And the tech results that we've gotten so far, which make up so much of the market's focus, have been reasonably solid, notwithstanding Tesla's results, which were mediocre. But that's kind of an issue onto itself. We get another four Mag 7 companies report this week, and if once again, a little bit like last quarter, we see that these companies are really trading on what is a much more secular or structural trend, which is this artificial intelligence trade, which has proved incredibly resilient despite these kind of cyclical factors weighing on the economy associated with trade policy uncertainty and tariffs. If we continue to see those sort of goods delivered, if you will, by those companies this week, earnings are a major reason why this market is still at record highs. So it's going to be a massive one. Arguably now the bar is set reasonably high because of valuations at the moment being fairly rich, and there is this kind of expectations for these companies to shoot the lights out. But in saying that, they have a history of outperforming, and if they do, again, it's another reason why to feel, despite some of these asymmetric risks in the market and rich valuations, the market can continue to sort of softly move higher in this upward trend because it does have that earnings support.
And Kyle, locally, importantly this week, we do get that quarterly read on inflation. Could well be pivotal as to what the RBA does next.
Yeah, and the forecast for the trend mean figure is to be about 2.7%. If you compare that where the RBA had projected inflation to be at the end of the June quarter in its last statement on monetary policy, 2.6% was the forecast. That's basically a rounding error because that number was a revision lower from the February projection, which did suggest that the trim mean inflation rate would be around 2.7%, and the RBA was still sort of baking into their forecast that there would be rate cuts by this stage anyway. So 2.6, 2.7%, it should green light more or less market expectations for another rate cut from the RBA at its next decision. The market's already pricing that in at about 100, almost 100% probability, perhaps even higher than that. There was a bit of a knock on the RBA that perhaps they confused the markets with, maybe leading them down the path that their reaction function had changed, and that they were sort of looking closer to sort of growth figures and labour market figures in particular, rather than inflation, to sort of set policy. Clearly, the RBA wants to see this quarterly inflation print before moving forward with any further interest rate cuts, as they had done in the past. But even if you sort of discount even if you take all of that in consideration, an inflation print around again 2.6, 2.7%, a labour market based on the latest labour force data that is softening, economic activity we already know is reasonably weak. We just need to get that number at around 2.7, as markets expect, to really green light that rate cut. If that happens, maybe there won't be that much of a move because there's already a cut more or less priced in. So if we do get an upside surprise, that's probably where the volatility will be. But nevertheless, the markets are really expecting a benign print, that it should be a rubber stamp for another rate cut, and that will effectively come at the RBA's next meeting, and then meetings subsequent to that as well.